Hello, everyone. We'll give everyone a chance to get seated. This is the weekly Camaplan webinar, and we're just making some checks on sound. So grab a cup of coffee. If you're eating lunch, take a few bites. And we just want to adjust the sound on our guest's end so that you can hear it.
How is it now?
Oh, that's very good. That works. If anybody has a problem,
Yeah.
I mean, just raise a hand or stick a Q&A. I'll leave that window open if anybody's got it. What I was doing was just dialing back the volume on my headphones, and that worked fine. But anyway,
Yeah.
all right. Let's get started. It's 1 after, so yeah, we're here to talk about physical gold, the barbarous relic, and we've got an expert on it, and he stops by about once a quarter here at Camaplan and briefs us on what's been going on in the market in general. And it's Brandon Green of Neptune Global, and we're happy to have him here with us today. He's a regular, and I've just got one or two housekeeping things to do, and then I'm going to unshare my screen, Brandon, and you can go ahead and pull up your slides. All right. Just a quick disclosure: the lawyers have to get involved in everything. We're not an investment advice counselors or certified financial planners. We're not CPAs. We're not lawyers. We don't provide any advice or endorsements or recommendations for any investments that you might be looking at. Everything done here is done for educational purposes and solely for educational purposes. If you need assistance, and we say this over and over again, I probably say it in my sleep, that before you do anything, consult your tax specialist, your CPA, your lawyers if you have to, before you do anything. So, Brandon, I'm going to go ahead and unshare my screen. And
I share?
yes, you do.
All right. Okay. Thanks, everybody. Thanks, Joe. Just pleasure to meet everybody, or will hopefully meet everybody. Just to let you guys know, if you're wondering why I have Toronto in the background at Neptune Global, we all put our where we're originally from because we're scattered around and where we're originally from. And I'm Canadian, originally from Toronto, and where I got my start in precious metals, where the largest mining funding and community is, along with where I started with Sprott, who Eric Sprott is one of the most popular names in the business. So I just wanted to clarify that. Sometimes I get commented often when I do that. So when I'm in meetings and stuff. So let's get started here. Want me to click? Oh, go ahead.
Yeah, go ahead and get your. I can't see your screen. I see my screen. But
I got to click share, I think.
You got to click share, and then you have to select the screen, I think. And then you have to, once you select here, I think we're getting there now. Once you select the screen, there we go.
Bingo. How are we?
We're looking good.
All right, good stuff. All right, let's get started. This is not going to be too long. I am expecting about 20 minutes. Plus questions. But I want to get a good deep dive today. We're going to talk about the precious metals market in general for those of you who might be a little new, and then we have a little bit of a subject of why it still outshines mining stocks, which we're going to get into towards the end. So, of course, just like Camaplan, we'd like to have a disclaimer as well that this is not considered direct investment advice. Contact your advisor. Okay. So we're going to start with the precious metals market in general. What does it mean? What does it entail? Types of metals, trading, what's it used for, and so forth from there. When we talk about precious metals, we're mainly talking about the four major metals: gold, silver, platinum, palladium, in an investable sense. There's plenty of metals out there, precious metals. Rhodium would be another one that sometimes comes up in the same context or conversations. Maybe copper. Copper will actually come up for a second later. More of industrial metal, but these are the four precious metals that when somebody's talking about precious metals, these are the ones they're probably most likely speaking of. Gold being the most popular, silver, and then platinum, palladium, the white metals after that. Market types out there, typically we have our ETFs, our GLDs, SLVs, PSLVs, GLDMs, a lot of different ETFs that are out there. Futures markets that we hear about, the futures deliveries. We hear about what is eligible for delivery in a vault and how these may be traded often in a margin sense, lots of leverage, and mining stocks that we're going to be speaking about. Those could be producers, people that have been around forever, Barrick, Newmont, or they could be juniors. I can't even name a junior off here right now, but there's also explorers, people who are just bought a property and they're exploring. And then there's the physical market, bars, coins, and allocated, unallocated storage. You could put jewelry in with that, but we're talking about more of a market and investment style. Okay, and these the global market sectors, which are like jewelry, central banks, ETFs that we mentioned, and industrial use. Okay, so gold, silver, and many different applications and like the screens you're using right now. And the major demand drivers, geopolitical instability. We have a little bit of that going on right now, just a little bit. Monetary policy, which we have, is definitely one of the largest topics in the world with tariffs, funding bills right now. What kind of deficit will come out of that? Inflation and industrial uses, and a lot of speculation, right? All of these factors move the gold price, move the silver price, platinum, palladium, speculation day to day, geopolitical week to week, but monetary and inflation and industrial are more of a longer term when you're looking at what drives the market. So let's take a look at what the physical gold market right now, how it's spread out between a lot of these different areas where it all ends up. So jewelry accounts for 46% of what's out there right now. So about $6 trillion, 95,000 metric tons. Central banks are holding around 17%, $2 trillion. Bars and coins are, in your home or in vaults, are around 21%. And believe it or not, the ETFs that we all hear about that get the most attention, unfortunately, they're only holding about 2%, right? So, $200 billion, $2.2 trillion. So the remainder is industrial and financial institutions holding it in multiples of ways at 15%. I put that, even though it's higher, it's just it's a mix of everything. So each one of those is definitely going to have a lower percentage. Saying that, where does the demand come from, right? So where is the demand coming from to get out there? It's a little bit different. It does have a little bit different of a breakdown. So the sources, right? The sources of demand, annual net demand is about 3,000 tons as per World Gold Council, okay? So for the expansion side, jewelry is going to be about 35% of it. I know it was a little bit higher on the last slide, but that's retained, right? So this is an annual demand. How much is going into jewelry? 7% is for technology, 39% for investment, right? That's more of an uncertainty, right? If you're buying, or speculation a little bit, if you're buying to hold for a longer period of time, right? And then central banks are 19. They're a large component, but they are both, right? They're buying if their country's expanding and they need to, they want to have a certain percentage of their reserves per GDP, et cetera, but they're also buying in uncertainty, which right now, a lot of them are buying. They have been buying, net buyers for a very long time and have been increasing the past several years. And that is something that we'll definitely take a look at. Now, of that 266 trillion in the financial assets, only 1% is in gold. So if you think about it, all the stocks, bonds, and other investments, only 1% is in gold. So what would happen if a fraction moved into gold? So here's the breakdown, right? Debt securities, bonds and so forth, 45%, equities, 44%, alternatives, 5%, which are increasing rapidly. But if this scale just tilted, if just 1% of the debt went into gold, that means gold's 2%. That means gold has to double in price. So if there is a global shift where people really start to not believe in the equities, believe in debt securities, alternatives, I would say is not an issue because gold is sometimes put into the alternative realm. You'll see it has to. The math doesn't lie, right? If that money needs to move into gold, that demand will be there, and the bids and offers will bring that price up. Because if it's going to be 2%, it has to be double the price. Now, the people issue more debt, people issue more equities, and more gold is mined. But gold is not like debt and equities that can be just issued immediately, regardless of futures and different things. It has to come out of the ground. So one aspect of the gold market some people are surprised to see is the actual daily trading value and where it sits in the whole scheme of things. It's the second largest traded. We hear about the euro, the Dow Jones, and corporates and all this kind of stuff. It's the second largest traded. I believe that's at 177 per day. Obviously, the stock market is big. That's something we can't ignore. But the gold market is a lot bigger than what a lot of people seem to understand. And those players in the business using, trading these gold and silver and all this stuff in the background, understand that this market is a big market. And there's a lot of trading out there. And that's notional trading value. So that's the amount passed in value per day. Not the amount of trades or anything like that. The amount of volume is different than the notional trading volume. The amount of volume you see in the stock market is how many stocks traded. So if you have a stock trading at $100, trades once, but you have a stock trading at $1, trades 100 times, it has the same notional trading value. It doesn't matter. It costs that person $100 either way. So it's important to understand that kind of stuff. I hope I didn't lose anybody on that part, but it's important to understand where the value of trading really, really lies. So I want to take a step and look about how, where the gold silver performance happened this past quarter, okay? Because it really, really outshone the stock market, right? We have gold up 19%. This is Q1, right? I know we're a little bit past Q1, but it's easier to put it in the quarter sense. It's definitely up just as much. Gold's almost making new highs again. So, so we're up 19%. 18%, 9 and 8 in the metals. That's against the negative 4.6 in the stock market. Now, what was that? A little bit of Fed policy, lots of trade tensions. We know what's happening there. The BRICS, there's some news in the BRICS about more and more going into a gold-backed currency, and there were central bank purchases, which we'll see. We saw some ETF inflows, and the dollar lost some value against it. So besides that, the gold and silver reaction to tariff volatility definitely did come into play. Just today, we did see an announcement with a deal with the UK. It's sending the markets higher, and gold's around flat. Last I checked, silver is around flat. I mean, depending, but the volatility is still there. So one of the last slides on this is I want to show you guys the central bank purchases for the past quarter because they were just released last week. So in Q1 of this year, they added 244 tons to the global reserves. You can see that on the far right. But if you compare that for the past 10 years, we're still well above the average. I mean, there was that one quarter, I don't know when that would be, maybe Q3 2020, where they were net sellers, just one quarter. But as you can see, we are flying high the past 4 years, 4 years. So when central banks purchase, the price moves. And they are not stopping right now. They are not stopping at all. So they know what's up. They know some things are happening. They know they need to protect their country in that sort of aspect. Here at Neptune, we really like to talk about silver as much as gold. Gold is, you know, it's the king. Everybody knows about it. It's something that, you know, 9 out of 10 people would probably prefer more, but those who understand silver can see that there is an opportunity there because of lots of different stuff. It's still well below its nominal and inflation adjusted highs. So its nominal high is 50. It's pretty much hit it twice in history, in the early 80s and in 2011. If you even take the inflation adjusted of the 80s, it's well over $140 an ounce, inflation adjusted. So, you know, we're sitting in the 30s. So there is a lot of potential there. It could take a little while, but there's a lot more potential for silver to get to these numbers. And I think gold to continue to make, it's going to continue to make highs, but silver will come along for that ride, and you can see this thing shot up. The industrial growth is huge. I mean, electric vehicles, solar, all of this is increasing demand, right? It's all of it. It's not stopping. They need more. Obviously, solar is a big thing right now. I have solar panels on my place, and a lot of you probably do too, depending on where you are. They are getting cheaper to make, and the ROI is coming down. So demand is definitely coming up on those. The gold-silver ratio is a hot topic right now. So that's how many ounces of silver by 1 ounce of gold. Right now, it's like 103. It's fluctuating every day, but it's over 100. And only twice in history has it popped up above 100. And these are only times when the market is, when the market is shifting to the safe haven, a short-term flight, you know, trading, like something's happening, something bad happened, somebody announced something and they went to gold. But it does come back. It comes back. In the past 20 years, it's been historically around 80 to 1, actually less than 20 years. It's been around 70 to 80 to 1. But if you look in the past like 50, 60 years, we're looking at 40 to 1. And there's a common knowledge out there that it's actually the multi-century ratio is 15 to 1. 15 ounces out of the ground for every ounce of gold. Now, demand will change these prices after that, but that was what's in the ground. So, like I said, returning 60 to major to 1. So I wanted to just let you know, if we have gold at 3,300, and we just went back to this 50-year average at 40 to 1, we'll have $83 silver. So that's 2.5 times pretty much where it is right now, right? So, or 150% returns. When could that be? It could be any time. But there's a lot of reasons to consider this as an overweight because of the potential, or the potential it's not going to go down. Now remember, when that gold, in order for that ratio to come down, gold either silver has to go faster increase than gold, or it decreases less of a rate than gold. So either way, even if there is a small downturn, we still think it's safer, right? Because gold has popped up right now, right? That's all trading, all buying in paper markets, and lots of bars and coins from us in different ways. So I'll leave it that one for now. Spent enough time on here. But if you want to talk more about that, I can, and my professionals can in the future. So onto our final subject and the core of this presentation is about is how are we looking at physical gold versus mining stocks, right? A lot of people think, okay, I'm in a mining stock. I got gold, kind of tracks it a little bit, but not really. It can on the short term. Day to day, they're gonna look similar. You're gonna see gold up 1%, and then maybe the minor up 0.8 or 1.2, and you'll see the junior, which is speculative, up 5 or down 5, because it's a play on, okay, how much money are they going to make off of this gold, right? That's all it is, right? This is the same thing as when Apple says they're going to sell 1 million phones, then that's going to be, that's how the stock price is going to move on that. So what's the gold price moving? If it's going up, the miners are going to make more money, assuming all other expenses remain the same. So it's definitely something to look at, but let's look at the actual historical comparison of physical gold versus the mining stocks. Okay. Spot gold has consistently outperformed the mining stocks. Over 20 years, spot gold is up 500% versus the average of the top 5 miners, Agnicos, Barrick, all these companies, up 191%. The GDX, which is it's not 20 years old, so you couldn't use those numbers. Its 18-year return is only 17. The GDX has about I think it's 60 or 38 of the top in market cap producers. It's a very well-known ETF. It's only up 7% versus gold of 318%. Total return from Morningstar. Okay, so stocks don't necessarily go gold ownership. Okay, they're volatile. They're equities. They have CEOs. They have capital expenditures. They have lawsuits. They have a lot of different things, but physical gold does not have that. Physical gold doesn't have earnings. You're right. They don't have good earnings reports, but they don't have bad either. And they don't have anybody to really screw it up. So I just want to put this quickly into a chart so you guys see what it is, right? So this is what I'm talking about. I use the 19-year because of the May 6, 2006. But if you look at spot gold versus the GDX versus the average of the top 5 miners, besides the 10-year, we're good. And you don't buy gold for 2 years, 5 years. You buy it for the long term. And in the end, you can either buy the real thing or you can hope that you picked really well. Some people do, and they'll tell you all about it, or they might not tell you all about the ones that they didn't pick that weren't good, right? But you always hear about the good picks. So be careful of that, especially the people that claim they know what they're doing in that. There's some good people out there that actually know what they're doing, especially with the juniors. But I'm speaking more about the people that aren't really their own X. So I want to tell you about the key risks of mining stocks and then why it's good for gold. So you have a lot of volatility in these stocks. So if you want to try and buy higher one day or buy lower and sell higher, it's going to be tough. They're subject to bigger price swings, project delays. That's something that will eat at their bottom line. Doesn't matter where gold is. Big project delay, their bottom line's there, and political risk, which is huge, right? Especially right now in lots of everybody's in a protectionist, zone right now and feeling. You could have lots of political risk, right, in these different countries. Operational equipment fails. Everybody's equipment fails. Your car fails. A coffee maker failed. These things fail, and that is going to hurt the profit because that's what you're betting on, right? You're investing in the profit. Labor issues and production shortfalls. So the jurisdictional regulatory is a really big one, right? Because you just don't know instability. The local strikes, huge strikes that happen and shut down the mines. And environmental regulation, which can all of a sudden they can change their mind about what sort of environmental issues are happening in that zone, and the government is leaning towards more environmentally friendly, and they change their ways. And of course, cost inflation, salaries, the oil itself. Oil goes up. You got all that. You need it to get them pulling out of the ground, and reserve depletion, which where they are operating does not operate forever. So you have that. That's a huge risk. And all of this is good for bullion because all of it will help the supply demand. There will be less supply. And that's just the fact and the truth. Less supply will push up the physical price. What we want in the physical market is a nice slow rise. We don't want these large swings, right, that these others give us. We want to just be able to feel confident that the bullion is increasing value and protecting. But you're not going to get this with the mining stocks, at least some of them, especially if they don't really have their grip on their costs and their company. And finally, on this part, I'm going to talk about some recent news, very, very recent. So John Ing actually out of Toronto, who is on BNN, which is Bloomberg BNN in Toronto, was on there yesterday speaking yesterday, speaking about he works with investors and mining companies and consults in this market and knows a lot about what's going on in the mining industry. And he says costs are a big problem right now for the mining industry. They are going up fast. Like Barrick and Newmont costs were up 13% in the past year. They are running short of reserves, so they are finding that they're not hitting as much as they used to. And what they have to do is they have to build a new mine. And that takes 15 years to get that all the way through. According to him, this is what he said. I didn't think it was that long, but there's very little in construction right now. And the last thing he said was, he talked about royalties. And I've heard this many times throughout my time. Like I prefer royalties. And he says the royalties are good in more of a bear market. But they are very overpriced right now. So if you've been considering a royalty stock in this market, he believes they're very overpriced. Barrick Gold, one of the biggest names, just announced that they're going to move into copper. I don't know the full reason behind this, but their job is to buy and sell or acquire and sell. So maybe they're seeing something else out there, right? Maybe they said, oh, maybe gold might not be good enough to keep Barrick, remove the gold, right? Facebook removed that. Now it's Meta because they have every other company. Maybe they need to start doing something different to keep their shareholders happy. They're moving into copper. I can look in this a little bit more, but they did announce it recently. Something I wanted to get in here right away. This morning, Muriel Rubini was on Bloomberg. Caught him there. You know, he's a very, very widely respected economist, and he has a couple firms in New York. He's blatantly said he likes gold because it can't be confiscated. And I want to point out that yes, we've seen that in the past, but in today's age, it's very difficult. We are not in the same time when the confiscation happened earlier this last century, right? So now it's easier to do bank accounts. We saw that with Russia and the different wars, and when countries do these things, bank accounts are easy. Anything digital is easy. But gold, it's not like it was before. Even if they tried to do it, it would cost them more to get out of there. But he specifically stated this on Bloomberg's on their TV station. So it was very interesting in these past few days. There was quite a few announcements, and it was a major topic in the news. You know, on all of these stations, Bloomberg's on both sides. You know, often it's a stocks and bonds kind of channel, but a lot of people are talking about gold right now. So, in conclusion, just so you all know who we are and how we work with Kama as well. So I'm gonna move this, I can't see, 1 second. All right. You know, we work with individual investors, family offices, wealth managers, and institutions to provide physical metal for their investments. As with Kama, we work with them on an IRA side of things. We work with them with individuals and wealth managers. So clients can buy physical metal and hold it in their IRA account. We do this on a direct basis as well, where we store it for the client or we ship it to them. We will ship bars, coins, in all forms to all of our clients that we've had for 23 years. There we go. All right. So yes, physical metals, global shipping, and insured vault services. And one thing important to remember when you're a metals investor is direct ownership, audited storage, real-time access, and make sure it's London Bullion Market Association approved metal backing it. Okay, the LBMA, where this whole fix started and so forth from there. One thing we have that's different than if you've ever talked to a bullion dealer out there at any time, we have special proprietary products that are built for you to get a direct allocation of metal at a better price than buying a bar or coin, diversified or directly in gold and silver. Okay, it's the vault accounts and the PMC ounce, where you can get that direct allocation in the vault, real-time trading, and fully IRA approved, held within your Cam Plan account. Okay, we do this is actually the primary of our business with Camo. We do a lot of clients do prefer to use these. Whichever you decide, if you want the vault access or the PMC, or you want gold eagles, because that's what you like. You want the American coin. Maybe you have family in Britain. You want the Britannia. Maybe you're Swiss. You want the Pan Swiss. That's okay too. But everything is LBMA approved and only approved in your IRA when you do this with Camo. That's it.
All right. Thanks for mentioning the IRA. Yes, we have precious metals accounts available for holding, direct holding of gold, silver, the other metals, and the PMC ounce, which is a very unusual product and allows you to participate in what happens with gold, silver, platinum, and palladium. So gives you exposure to all of those metals. It's a very interesting product to check out. Not that we can give an endorsement, but it's worth taking a look at. One question about the interplay between the price of gold and the mining shares. I noticed during the first 2 decades of this century, I was following it. I was avid reader of Agora Publishings. They were the hard asset guys, and they called gold a trade of the decade, the first decade of the century. And I noticed that the interest in mining shares kind of parallel or lagged behind the new plateaus in the price of gold. For example, we went from $300-400 an ounce in around 2000 up to around, I think at the end of the decade, it was in the 800-900, and it spiked up to 1600. And then shortly after that, it spiked up to 2000 and then rested somewhere around 12 to 14 for almost a decade. I noticed that their interest in mining shares and their activity surrounding it kind of lagged those spikes, those run-ups in the gold price. And I thought it was a supply and demand issue, but listening to you here, it seems just more like people trying to get additional play out of the price of gold spiking. Is it safe to say that it's a lagging indicator, or the mining share prices are lagging indicators?
So what do you mean they lag? When you say lagging indicator, you mean like they lag? The price of gold runs up later.
The price of gold runs up, and then there's interest in, and a supply and demand interest is that, oh gosh, maybe we should put some more in the market, and so money pours into mining shares.
Yeah.
Then it levels
possibly,
off.
But what I would think.
Go ahead.
Sorry, I was going to say what I think is like you're going to have that price of gold go up, and then they have to do earnings reports. Right. So nobody really knows what their bottom line is. So you can only speculate.
Gotcha.
You can only speculate. If gold goes up for a little bit, that's fine. And then they may go up with it because speculation goes in there, but you don't know what they're really going to produce in an earnings report, right? They do sell gold, but you're not going to know their bottom line. So they still react on earnings. Right? They still react on earnings, and nobody really knows what that's going to be. You would think it was just so easy to just follow the gold price, but like a part of my presentation, like you're gonna have to wait quarterly,
Yeah.
right? That's the whole thing, right? So you're gonna see some trading in between, but if gold goes up, yeah, you're gonna see it go up with it. But then as long as they're making the profit, the bottom line, right? Then they'll announce it a quarter later, right? So and also you got to remember they're also selling futures against these, right? So if you're a producer, the futures market, not to get too deep, but you might be selling your gold a year, 2 years out. If you like the price right now, and you can sell a future in December 2027, right? You can pre-sell your mining, and that shows up, you're bringing that money in. Obviously, the analysts will look at all this stuff. But then you got to, the traders have to figure out what have they pre-sold, what have they not. There's a lot more to it. There's a lot more confusion that if you really know what you're doing, you're an analyst or you're a professional, okay. And you want to do it company by company and analyze the country they're in with what they could have bought and how much it's going to cost to get it. There's a whole load. You better be good at it. It's not what it's not the sector we're in or what we believe, but some people are good at it, and we have a partner who's really good at working with those companies as well. But we believe it's better to just do the physical metal, the end product, if that's the case.
Yeah, it's interesting because unlike other investment opportunities where you're looking at the underlying opportunity, the market, the product, and then you're looking at that would be the horse, and then you're looking at the rider, which is the management team and all the other factors affecting it and how the enterprise is run. Gold is really just the horse, and there's no rider, but the market's the rider, if anything else. But
I feel you.
One other question. Gold at its peak, I'm really dating myself, and most people listening probably weren't alive, or maybe they were. But gold went to 850 sometime around 1980, and I remember having conversations with you about when is it going to reach that peak again in inflation-adjusted terms. We're there now, roughly speaking, at $3,300 an ounce. So,
right.
Given everything how much more room to run does it have? I guess it's as long as uncertainty is, as long as markets are uncertain, or does it have room to run for other reasons?
Well, that's the gentleman was posed that question on BNN on Wednesday, just about the physical price itself, right? They asked him, he didn't really talk. They asked him about physical, and they asked him, where do you see that between mining stocks and what's better play? But he basically said, like, name the number, for lack of a better term. And I have the clip for that, so please reach out to me. I can send you the clip for that. For that being an interview. He basically, I'm paraphrasing. It was something like, just name it, because as we continue on this path with the wars and with tariffs, deals not happening, deals happening, and in different aspects of uncertainty, it's just like it just, you don't know when it's going to stop. Right. And because this is just pure speculation and protection demand rather than supply cost demand. Right. So supply cost is sort of pushing it up. Right. So the supply is down because costs are up.
Yeah. One of our viewers or participants today mentioned, he's saying tariffs and uncertainty, banks buying gold, and that totally makes sense. And rather that tariffs would be tariffs and things, and global uncertainty and war and anything else are externalities that affect the price of gold. Gold is like oil; it's fungible. It moves across the borders, and it's a global market. And it's not so directly affected by tariffs. It's affected by the uncertainty that any market uncertainty, anything that creates market uncertainty. So it's always going to be indirectly affected by that, whether it's geopolitical trouble or, natural disasters or anything else that might create more uncertainty. Right now, we're in a really uncertain time. Things aren't going to shake out for a while. So,
And the interesting thing though is that, with how much the portfolio you put in uncertainty, right? Lots of people say 10%. It's been a 10% gold's been a common notion or phrase about it, but like as you guys saw, like only 1% of total market, only 1% in the total market. Now, mind you, this is with institutions and funds and different various portfolios, and that calculation. I don't really know what everything was taken into play. I mean, it's not that wasn't personal portfolios. This is the broad market,
right.
but it's still, as far as we understand and what professionals understand, it's still far below 10% the average person, right? What do you put into there, right? We all have stocks and bonds and ETFs and different types of securities and homes and things like that, and gold should play a factor, but it's not playing a factor as much as in personal portfolios as 10%, as is commonly stated.
Interesting. Well, we feel the same way about alternative assets in general, is that there's just so much potential for people to get involved with this. And direct ownership of gold as opposed to owning ETFs. We feel the same way. It's relatively untapped. I think, out of the 29 or 30 trillion dollars in retirement accounts, only about 3 trillion, under 3 trillion is over on the self-directed side, doing things like what you've described today. So, yeah. Lots of potential all around. I don't see any other questions, and yeah, we're in the range where we can kind of wrap things up. Brandon, thank you so much for coming on. You're great with these things coming on every quarter and filling us in on what's going on. It's always been always exciting to watch the market these days, even if it gives you the if it gives you the vapors. But thanks for bringing some clarity to what we're watching out there.
All right. Yes. Thank you. Happy to be here. Looking forward to, we'll get one going probably after the summer.
Sounds good.
Shortly after.
And just one housekeeping note, everyone that signed up will get a replay link of this, so you can go back over it and take a closer look at those slides. Take care, everybody. Thanks for coming. We appreciate your time, and we'll see you next week.
All right.